Hi everyone, today we're doing notes for 8.8 on credit cards. So it says since you're not typically taking a loan for some amount one time and then paying regular payments over a period of time, what you pay each month on a credit card depends on the unpaid balance and the interest rate. Many people do not pay close enough attention to the interest rate on credit card billing statements. There are many credit cards that list their interest rate as 1.5%. Which sounds small, but this is a monthly rate, not a yearly rate. You can avoid interest charges by not using your credit cards for cash advances and by paying off your balance at the end of each month. Credit cards are convenient to have, but if you cannot afford to pay off the balance at the end of each month, then you cannot afford to buy what you are buying. Any amount that you do not pay at the end of the month is carried over to the next billing statement as an unpaid balance, and now interest starts growing very rapidly. How much interest you pay depends on the average daily balance. So revolving credit, this is an open installment loan. Credit card loans require only a minimum monthly payment that depends on the unpaid balance and the interest rate. Itemized billing, a statement that includes your unpaid balance, the total owed, and the list of purchases. So to figure out the average daily balance, to compute the monthly interest, you compute I equals PRT, so our simple interest formula, where P is the average daily balance, R is the monthly interest rate, and T is 1 month. The average daily balance is computed as follows. So you take the sum of the unpaid balances for each day in the billing period divided by the number of days in the billing period. So again, I'm going to underline these. P is our average daily balance. R is the monthly interest rate, and I'm going to circle monthly so that stands out, and our time is 1 month. All right, so there's different ways you can think about this. So let's say you need to average these numbers. We have 2, 2, 2, 2, 2, 2, 3, 3, 3, 3, 4, and 4. So one way to find the average is to add up all the individual numbers and divide by how many numbers you have. So we're dividing by 12 here. That involves a lot of adding of the same number over and over. So you can also find the average this way. We're going to do 2 times 6 because there's 6 of them. 3 times 4 because there are 4 3s. And then 4 times 2 because there are 2 4s. Okay, and then we'll add that up and divide by 12. The second method takes a lot less key punching to compute, and it's the method we're going to use in computing the average daily balance. A month will typically have 30 or 31 days, and there will be many days where no charges or payments will be made, and so the daily balance for many days in a row will be the same. Instead of adding that number again and again and again, we can count how many days we have that same balance and multiply like we did in the second computation above. All right, so here's our example. A credit card computes interest using the average daily balance method. The monthly interest rate is 1.6% of the average daily balance. The following transactions occurred during the January 1st to January 31st billing period. So we see there is a previous balance of $8,240. January 1st is the billing date. There was a payment, $350 credit on January 7th. Charge at the Apple Store on January 15th, charge at Mod Pizza on January 17th, charge at Kohl's on January 30th. January 31st was the end of the billing period, and then your payment is due February 9th. So we want to find the average daily balance for the billing period, and we're going to round to the nearest cent or 2 decimal places. So January 1st, we had an unpaid balance right here, this previous balance of $8,240. So if you notice, from that day until January 7th, we were at $8,240. So that's 6 days where we were at this balance. So if I take the unpaid amount times the number of days, I have $8,240. I'm going to multiply that by 6, and that's going to give us $49,440. Okay, January 7th, there was a credit of $350, which means we're going to subtract that. So I have 8240 minus 350. And so that gives us, now our unpaid balance is $7,890. The next charge occurs on the 15th. So that is 8 days where we are at that unpaid balance. So $7,890 times 8. This is going to give us $63,120. Okay, January 15th, there was a charge at the Apple Store. So we take our $7,890 plus $1,405. And now our unpaid balance is $9,295. We see this is for January 15th and 16th because the next charge is the 17th. So this is 2 days. 2 times 9,295 is going to give us $18,590. Next is the charge at Mod Pizza. So we have 9,295 plus 4,520. Now our unpaid balance is $9,340.20. We see then the next charge isn't until January 30th. So there are 13 days at this unpaid balance. So $9,340.20 times 13, that gives us $121,422.60. All right, last we have the charge at Kohl's. So we have $9,340.20 plus the $180.72. I want you to find this unpaid balance, the number of days, and then get the number of unpaid times the number of days. So fill in the rest of this last line of the chart. All right, so this total we have here, this is $9,520.92. The number of days we have at this, we have January 30th and 31st, so that's 2 days. If I multiply those two quantities, that gives us $19,041.84. Okay, so now just to check, we should, for our days, for the unpaid balance, this total should always be the number of days in the month. If I add this up, 6 plus 8 plus 2 plus 13 plus 2, that total is 31, like we want. Okay, so it says the average daily balance. It's the sum of the unpaid balances for each day in the billing period divided by the number of days in the billing period. Okay, so we need to get the total of this last column as well. So if we add all of these up, this comes out to give us $271,614.44. All right, so we want to find the average daily balance first, and then we can compute part B, where we find the interest to be paid. So let's do the average daily balance. I'm going to say this is ADB for average daily balance. So the sum of the unpaid balances for each day, that is what we just calculated, the $271,614.44, divided by the total number of days, 31. And this comes out to be about $8,761.76. Again, we have to round it to the nearest cent because we're dealing with money. All right, so we want to find the interest to be paid here. So our interest, if you recall, I is equal to P times R times T. Okay, so our average daily balance, that represents our P. Our rate, we had said earlier, up here is 1.6%. So our R is 0.016. and our time is 1 month. Now remember, this rate is a monthly interest rate, so our time, we can just say 1. Previous sections, we were given an annual interest rate. That's why we did 1/12. But again, in this case, this is a monthly interest rate, so our time is 1 month. I want you to calculate the interest, please. Okay, we have I is equal to P times R times T. So our P, we said, is $8,761.76. Our rate is 0.016, and our T is 1. So if we multiply these, we get this is $140.19. All right, so to find the balance due on February 9th, the balance due that is going to be equal to the unpaid balance plus the interest. So our unpaid balance is right here, $9,520.92, and our interest we just found is $140.19. So let's add this up. $9,520.92 plus $140.19. And so our balance due is going to be $9,661.11. All right, last question. The minimum monthly payment is 1/36 of the balance due at the end of the billing period, rounded up to the nearest whole dollar. So again, this is rounded up to the nearest whole dollar. And you must pay at least $10. What is the minimum monthly payment due on February 9th? I would like you to solve this one, please. Okay, so our balance due is $9,661.11. And our monthly payment is 1/36 of this. So I can either multiply by 1/36 or I can simply divide by 36. And this comes out to give us $268.36. And we said we have to round this up to the nearest whole dollar. So this is going to be $269 because we always round it up. And so that is your minimum monthly payment that's due on February 9th. So again, this is a summary of figuring out the average daily balance that we just went over. Here are some pros and cons of using credit cards. So I would suggest that you read through this, especially since many of you are going to start using credit cards soon if you haven't already. So, you know, like I said, I would read through this just because it's interesting. So understanding the difference between credit cards and debit cards. So debit cards, they look like credit cards but are not the same. These are linked to your bank account. The money you spend gets deducted from your bank account. You can't spend money you don't have. If you are using a debit card and you don't have the money in there, this will not work. Your card will get rejected. They will tell you when you try to check out, it'll say the card was declined, okay? They may not offer any protection that a credit card does for disputed charges, and it's easy to rack up overdraft charges if the bank enrolls you in an overdraft protection plan. So basically what that means is instead of rejecting your card, if you only have $200 in your checking account and you try to buy a $400 TV, because let's say you're refurnishing an apartment, they will let the charge go through and then they will charge you an overdraft fee because they took money that they are basically loaning it out to you. instead of it being money that you're paying for, okay? And so, let's say it was 2 days before you get paid and you only have $25 in your checking account. Let's say that you went out to lunch, you went out to dinner, you got a Starbucks. Every time you charged and used that debit card, you would get charged that overdraft protection fee, which is typically $25, $20 or $25 every time you overdraft. So in the course of a day, if you bought 3 things, lunch, dinner, and a Starbucks, let's say, you could get charged $75 extra because you didn't have enough in your account. So debit cards, you want to treat these like if you have a check. A credit report. When you have your first credit card, your personal credit report begins. This has identifying information about you. It has a record of all your credit accounts, public record information. For example, if you ever had to declare bankruptcy, that would be listed on there. It also has collection agency account information. So let's say you just don't pay your credit cards and the credit card company sends you to a collection agency. That would show up at your credit report. And then it also shows inquiries, so companies who have asked about your credit. So if you were applying for a store credit card, let's say you wanted to get a Costco card or you wanted to get a Gap card, if you want to get those store credit cards, they will do an inquiry. They'll check your credit report to see if you have good credit before they allow you to apply for the card. The credit bureau, they collect credit information. On individual customers, and they provide credit reports. So what you can do is you can actually look up your credit report. You can go to places like Credit Karma. I know if you bank with Chase, they allow you access to a free credit report each month. So many banks offer that. So then you can see your credit report, and then you can see your credit score. And so your credit score has an enormous effect on your financial life. So this is basically the outline of credit scores. So if you have, 720 to 850, you have very good to excellent credit. You get the best interest rates on loans. If you're in the 300 to 579, you have very bad credit and you're likely to be denied credit. So basically, if you have good credit, banks are more likely to give you a car loan. They're more likely to give you a home loan. They're more likely to let you refinance to get a lower interest rate. They're more likely to give you credit cards with higher balances that you're allowed to spend if you have good credit and you show that you can pay things off. If you have bad credit, you're not going to be able to get those store cards. You're not going to get a great rate on a loan because you're more of a risk to loan out money to. So that's why banks and other companies will not give you as good of a rate. They'll charge you a much higher interest rate because it's more risky on them that you might not pay them back. Okay? And so here's just more tips on responsible credit card use. Again, I would read through those because they are interesting and it can help you. And that's all we have for today.